All right, y'all. Today was pretty interesting. All eyes were on Moody's and how the market would react. A lot of people were watching stocks, but honestly, they should have been watching mortgage rates and treasury yields because that is where we've seen the bulk of the moves. As we see, the stock market really was flat today, pretty much. The QQQ NASDAQ 100 ended up 10 basis points in the green today, and many stocks, Nvidia, Microsoft, gold down, Amazon up, Apple was down. That could have been its own deal going on with that. Bitcoin up. Because if the credit worthiness of the United States, where the federal or the reserve currency is stationed, goes down, that just like it makes sense. I wonder why gold's down on that though. I don't know. But everybody was watching Moody's, and where we seen the bulk of the reaction from this downgrade was in mortgage rates. And we'll talk about what mortgage rates are tied to. But last week's rate of 6.81%, which was the national rate for the 30-year fixed rate mortgage, was the highest since April. Mortgage rates are now above 7% yet again, and this is bad news for a few different parties in the real estate space. Think about the buyers out there, the sellers out there, builders who are in the business to build homes and sell them for a profit. These higher prices and higher rates makes it a bad time for everybody. I imagine a lot of people in this industry right now are not happy campers. Now, if you're able to swoop up a deal and take advantage of these market swings, you're in a different spot. But broadly, the real estate market is softening. Moody's noted that the U.S.'s financial and economic strengths no longer counter the balance between the decline in fiscal metrics. They're thinking about government spending as an issue and how much this federal debt, how much interest the federal government is paying on debt. Really government debt altogether. So these concerns are really sending Moody's the sign that, they're not really managing it really well. Lawrence Yuns from the National Association of Realtors believes the rise in rates won't last long because the overall consumer inflation rate has been calming down, and a further decline in the shelter component of inflation will help to keep this inflation controlled. And if you're watching CPI, shelter has been where we've seen the sticky inflation or the inflation that hasn't really been calming down as a percentage of rising prices. And that's what's been holding inflation up in recent CPI reports and releases. So I wonder if Lawrence Yuns is kind of making the prediction that, hey, these higher rates will push asset prices down, and because it further tightens credit availability, which makes less homes sell because less buyers could qualify for a loan, even impacting these builders who have jobs for people who make money off of doing this. So it's a trickle effect. And I wonder if he's making the prediction that the Fed could be cutting soon from this. Now, who knows what could really happen, because right now a lot of people don't think that the Fed will cut until at least after June and July. A lot of people think the first time we'll see a cut is in September, and that's actually where we got the highest chance at a 50.9% expected rate that the Fed cuts rates by 0.25% for the first time. Because here in June 18, we're at 91% chance they stay the same. What about July 30th? Pretty much a 67% chance they stay the same. So a lot of people aren't hanging the hats on them cutting rates anytime soon, but after we get more reports and what's going on with the economy, and especially as we're going into winter. Also, these mortgage rates could ease as we get more, general direction about tariffs, if the tariff policy becomes more clear, because who knows what could happen out of this. There's a chance that home sales may improve to 2024 levels is what some people think, but this, of course, considering the fact that home sales last year were at the slowest they've been since 1995. So the bar isn't very high. That was a 30-year low. So the real estate market's definitely in a slump. They're expecting us to do a little bit better, but let's think about some of the numbers right now. Right now, to really help out the business, about 34% of builders are cutting prices in May alone, and that's up 29% from last month in March. The size of the cuts are about 5%, but that all varies depending on where you're at. And 25% of listings on Zillow saw a price cut in April. Now, these mortgage rates, let's talk about the mortgage rates a little bit more, because these mortgage rates follow the 30-year, well, they follow the Treasury yields. So the first Treasury yield that makes the most sense would be this 10-year Treasury yield. I don't know why I said 30 at first. I was looking at 30-year on my screen, but the 10-year Treasury yield, in 7 to 10 years, most things happen to a mortgage. Somebody sells their home, so it's paid off that way. They move and buy a different house. They might just pay off the mortgage completely and that disappears, or they refinance the loan. So those are a few different things that happen. So a lot of people compare the risk of lending somebody money on a home versus lending money to the US government for 10 years. And right now that baseline, which virtually riskless, because what are the odds the government doesn't pay you back? There's people who make arguments about it and stuff, but essentially speaking, the US government could just print money to pay you back. And them defaulting would be less so them not being able to pay you back versus them just not like refusing to pay you back. Those are probably more the odds of not getting paid back from the government that I've seen some strategists and economists mention. So right now that rate is 4.457%. So this is the least risky loan you could make with your money. So it's pretty much a guaranteed profit. Now, lending somebody money to buy a home, that's completely different. They could lose their job. They could destroy the house. They could stop paying us. Their credit could go down. So there's going to be a premium on top of that. And it looks like this premium is about 2.5-ish% on top of that. And then these terms, the further out you get, the more you'd want to get paid out, right? So today what was interesting with this downgrade, which influences these treasury prices, because if the US government's credit rating was as good as it could get and now it's just one notch below that, it's not the best no more. A lot of people argued that we're expecting this and this is a lagging indicator and it doesn't mean much. Either way, we've seen quite the move on treasuries today. Now, they did get bought up, and that could have been banks buying it with money that's not their money, with deposits. So a lot of people were talking about that, but the fact that we seen treasuries shoot up is the reason why we seen these 30-year fixed rate mortgages go up as well. And with these higher yields means higher borrowing costs, and it's more restrictive on the economy if you look at it like that, because now that the treasury yield's higher, which means the government has to pay more interest, you're going to expect that consumers will have to pay more interest too, because they're more risky than the government. And now everybody in the system is paying higher borrowing costs, the consumers, the businesses, and the US government. And the question then becomes, how long can the economy handle higher rates on a sustained basis? When does that become a problem? And I thought this article right here was interesting, why US consumers are more resilient than the economy might think. It was talking about how the markets currently discount a 40% chance of a recession in 2025 and 2 rate cuts from the Fed. Bank of America still estimate 1% GDP growth in the fourth quarter and no rate cuts before 2026. Now the CME Fed Watch tool disagrees, but it was looking at different ratios, like this ratio right here. Total and liquid household assets to liabilities. And it looks like it's been straight up for maybe since 2022-ish and straight up since then. And we're at decent levels. And the alarm bells technically aren't on if you're looking at some of the things this article considers. And then I think just mentioning the fact that people front ran tariffs and it gives them longer time, and now they got the 90-day reduction. There's a lot going on with that. But then on the opposite end, recession indicators are out of control. When will the madness end? And it was talking about pretty much that people are struggling. We're probably not seeing it in some of these other ratios people are looking at, but last month Beyonce tickets were selling for less than $60. We seen GDP negative for the first time. The economy contracted about 0.3% while it was expected to grow 40 basis points or 0.4% or something like that. And the timing is tough with the potential recession in cards. A lot of people are really feeling the weight of these high borrowing costs, which just went higher because the Treasury yield, which borrowing costs follow, which are tied to inflation expectations, and right now tariffs raised that. These borrowing costs went high, so that makes it more restrictive. Now, let's look at some more data together. Let's start off with the personal savings rate, which we seen during the pandemic that shot up. There's a lot of stimulus and stuff to help stimulate the economy. The little gray line is where the recession started and ended. I wanted to look closer to where we're at right now with the savings rate. Here, last 5 years. And it looks like the savings rate actually has gone down as of recently. I mean, these yields have been a little higher for a while. Let's look at the 5 year. Yeah, so we see these treasury yields rising the last 5 years. Let's look at the 30 year. So longer term borrowing as well, all of that's going up. And savings are starting to diminish a little bit. I mean, they're still high, 3.9% of the savings rate, which the savings rate, personal savings rate, is expressed as a percentage of disposable income, often more insightful than the dollar amount, which you could look at the personal saving on the St. Louis Fred website, which is where I'm viewing this. Watch for sudden drops of the personal savings rate because this equals recession risk. These spikes could be people saving instead of spending money, and that's bearish for GDP growth in the short term. So right now the savings rate's going down, so people are spending their savings pretty much. They're not saving money, they're spending a little bit more than they were last month. And I'm interested to see how that comes out now because that could have been frontlining the tariffs, honestly. So that's interesting. And then I got another data set I want to look at. Consumer debt services, service payments as a percentage of disposable personal income. And this measures the portion of household disposable income that goes toward required debts, such as mortgage payments, rent, auto loans, credit card minimums, student loans. And it takes the total monthly debts and divides it by its total disposable income and multiplies that by 100. And then it's expressed as a percentage, not a dollar amount. Now, what do we see here? Well, let me make sure I got this right. It measures the portion of household disposable income that goes toward required debts. So the portion of that, so far from what we see from this graph, has been increasing. We only got Q4 2024 data, so I'm interested to see how it comes in. But the common trend here is up on this chart. Now I got a few more I want to look at. This one is total consumer credit owned and securitized. Now I believe we wanted to figure out why total consumer credit owned gone up, and this one's just been straight up. And then household debt, we slightly seen that decrease. So just kind of going through the rabbit hole, I was looking at it, and the notable drop in total consumer credit owned and securitized from November to December 2024, alongside the slight decrease in household debt service payments as a percentage of disposable personal income, can be attributed to several interrelated factors. And then it goes into talking about the total consumer credit drop. In December 2024, total consumer credit decreased by approximately 10 billion from 5. Yeah, so it went from 5 trillion to a little under 5 trillion in December. The decline was primarily driven by a significant reduction in revolving credit, which includes credit card debt. According to a KPMG report, revolving debt plummeted by 12% at an annual rate in November, following a 13.4% increase in the previous month. The sharp decline suggests that consumers became more cautious about taking on new debt, possibly due to high interest rates and economic uncertainty. What happened in November? That was right after T-Man got elected. Now let's look at why did household debt service payments only slightly decrease? It pretty much talks about the modest change can be attributed to a few different factors, including timing of debt payments. Because, for example, Thanksgiving was a little bit late and that could have pushed off some of the payments. So debt service payments are calculated based on scheduled payments, which may not immediately reflect reductions in outstanding debt. Interest rates. High interest rates during this period meant that even with reduced borrowing costs, the cost of servicing existing debt remained elevated. Disposable income levels. If disposable income remained relatively stable, the ratio of debt payments to income would not significantly change, even with the decrease in total debt. So the main takeaways is that consumer credit decreased due to reduced borrowing, particularly in revolving credit influenced by high interest rates and cautious consumer behavior. And that's where people's going to pay off the most. You want to get out of the high interest rate and hold on to your low. Imagine you got that pandemic low interest rate on your 30-year fixed rate mortgage. You'd be more inclined to pay off that 11% credit card or 20% credit card versus your 3% mortgage on your 30-year fixed rate mortgage on your home. Debt service payments remained relatively stable because scheduled payments and interest costs did not immediately adjust to the reduced borrowing levels. Then we looked at a few different delinquency numbers. So first we wanted to look at delinquency on credit cards, and we seen that actually gone down. So it falls in line. People uncertain about the economy, plus it's your high interest rate debt. We had record savings a few years ago, so people spending that off to get out of debt, save a little bit of money up. But we see that the delinquency rate on consumer loans kind of increased during that same period. So I went right back to GPT and asked about that, and it was talking about how consumer loans seen an uptick mainly because of these student loan news coming out. So the resumption of student loan payments after a multi-year pandemic led to a significant spike in serious delinquencies. Specifically, the serious delinquency rate for student loans surged to 8% in Q1 2025, up from less than 1% during the payment pause. This increase substantially contributed to the overall rise in consumer loan delinquencies. I heard somebody talk about how people kind of forgot about it. Like they got used to not having to pay their student loans, and then it was almost like, this money I'm saving is mine to spend, and then they started going on vacations and stuff. Then auto loans, elevated delinquency rates in auto loans persisted, reflecting affordability challenges exacerbated by rising vehicle prices and finance costs. Back to these Treasury yields and lending people money and how they compare. Then we also seen that other consumer loans, delinquencies in other categories such as unsecured personal loans, they don't have nothing to lose. It's not even secured against anything. Like your car, where you got to pledge it as collateral for the auto loan, and if you stop paying the auto loan, they take the car away. What are you going to take if your unsecured personal loan, like your credit score, if you weren't gonna be able to pay it in the first place, you already expected that. You already considered that in your financial analysis. Now, the decline in delinquency rate on credit cards, in contrast, was due to experienced a slight decline in Q4 2024, and this was attributed to stabilization of delinquencies. After a period of rapid increase, credit card delinquencies became stable. Despite remaining elevated compared to pre-pandemic levels, the growth rate of delinquencies moderated in late 2024. Improved household financial health, gains in home equity, stock market, income growth bolstered household financial stability, enabling consumers to manage their credit card payments effectively. And then lender practices, they upped their standards. And then I think something else that this left out is the fact that there are so many ways to make side money these days. You could just sign up for Uber or Lyft and try to make some money after work, or pick up a side job doing this or that, or try to start your own business. There's a lot more ways to make money versus other periods of time, just because the internet and where society's gone to is completely changed from where it was at. Now, let's go back to stocks real quick, because we're watching stocks. We noted yesterday in yesterday's video on where stocks will go this week, really depending on how stocks open today. And they opened pretty flat. Everybody was like, I don't really know. I don't really know. What if this Moody's downgrade has reawakened the sell America trade, with stocks opening lower, not really moving? And then closer to the end of the day, we just seen this real big buying, just like in treasuries, where these yields started off a little bit higher than where they were. And then people seen that and they were like, bet, buy the dip, baby. And then they started buying the dip. And we see people bought the dip. And when the treasury yield goes down, that means the price of bonds went up because there's more demand for them. Now, when these yields go up, they're either selling more treasuries, and it's supply and demand, just like a stock price. So we seen stocks kind of start off low, and then they went higher in the day. People said, so this Moody stuff, it's slight, like Scott Bessent said, and all these people kind of blown it off. They must be right. Buy the dip. And that's exactly what we started seeing. We also seen Mike Wilson come out with Morgan Stanley. He's the chief stock market strategist, and he said that they're buyers of such a meaningful dip from this Moody's downgrade, because like I said earlier, many people are blowing this downgrade off, and a lot of people say they expected it. So what we've seen is that stocks closed out today mainly in the green. The S&P 500 has another streak of reaching 6-day gains, opening higher for 6 days. And what people are going to be continuing watching are how these stocks continue to move, but based on a few different things that we get. We still got earnings from Target, Lowe's, Home Depot, Ross, TJ Maxx, a lot of insight into the consumer, what they think about tariffs, where they see prices going. Do they forecast a recession? What does their forward guidance look like? And then trade talks, because this one's huge. They're saying that if countries don't negotiate in good faith, this is from Scott Bessent, that their tariff rates could go back to April 2nd levels. So who knows how negotiating with 150 countries is going to go, including China. But if they don't go well, expect higher prices. And when tariffs are for longer and or for higher than we expected, so are our inflation expectations. And remember, inflation expectations are what the 10-year Treasury yield follows. So if we expect things to be more expensive in the future, we're not going to loan our money for less. Man, if I'm going to give you $100 and I'm expecting prices to really go up, instead of 105, I might need like 110 back in a year. And then what else follows that indirectly? What follows the 10-year Treasury yield? Mortgage rates and credit card payments and all of these other things. So what happens in the case that it starts getting really hot in here and people can't spend money anymore, or afford things or whatnot? That's when the recession indicators really get out of control. And something that's really been holding up for a while and hasn't been shown up in the data is that consumers are spending well, so there's really no need to lay off yet. Everything's kind of looking good, and as long as the job market holds off, we could probably earn more time. So trade talks, that's the second thing we're going to be watching. Then we got some economic data releases coming out. Everybody's going to take all that with a grain of salt, but it's mainly trade talks. that's the elephant in the room, if that's the correct terminology on how you use that. We got some Fed speakers, but I feel like they only matter to an extent, because they're just going to tell us what we already know. Yeah, we don't know that we're going to cut rates yet. Like, y'all might just have to chill a while, get used to it. We need more data before we decide. And Jerome Powell said he's all right cutting being late to the party, being late cutting rates. We got John Williams today. He said tariffs are keeping households and businesses uncertain and putting major spending decisions on pause. So we just looked at personal savings rate, and we know that if the savings rate goes up, that's less money being spent. So money being spent goes down, and that higher the likelihood of a recession happening because the velocity of money slows down. The money circulating, like, I don't pay my rent now. The insurance the insurance rep's not getting his monthly payment, and now utilities, and then this and that, and the guy at AT&T, and I might cancel my Apple Music membership or Spotify. Like, all these different people don't get paid. And it's maybe not that serious, but just think about it like that. Like, the amount of times money turns over in the economy, how far that $1 you spend goes. So a lot of people aren't really expecting us getting much from the speakers, other than the Fed speakers, other than stuff we already know. We're going to keep waiting. Higher for longer. But on top of the higher for longer interest rates, now we got an extra rate, like an extra tax, and it's these tariffs. Now, without the tariffs, then interest rates are the shiny shoes in the store again. But right now it's tariffs, and it's going to continue being that. And a lot of people is just wondering, how long can this keep going? How high can these prices stay before consumers and businesses and governments can't reasonably sustain it? And that's what we're going to keep on watching, y'all. Hope y'all enjoyed this video. I'm out. Y'all have a good one.